Hello, I'm Mark Horton. I'm the creator of American Delusions, and welcome to this new video. I'm really pleased to present this story of the $47 trillion ripoff. So we'll begin with this graph. I call it the Great Divide. It displays data on productivity. That's this heavy blue line, and productivity is a measure of the increase in output of products and services per hour. So as you can see, productivity in the U.S. from 1948 to 2020 was a continuous upward motion. American workforce got more and more productive over this time. The second element on this graph is average wages. What's a typical worker earn? The thing to notice here, and it's very noticeable, is that between 1948 and 1979, the two lines squiggled around each other very happily. As productivity rose, wages rose with it. So workers kept their share of output. Just before we move on, you might note that would not argue that the income distribution was ideal at that point. There was considerable inequities in the economy, but nothing like what has occurred since the divide. So starting about 1979, you see this split where productivity continues to rise. It rose almost 60% between 1979 and 2019. While wages essentially went nowhere. Your typical worker gained a grand 14% over that whole period from 1979 to 2019. That's 30 years. This is the origin of the explosion in income inequality in the United States, which persists to this day. And here's we'll investigate this inequality a little bit deeper. So here's the per capita GDP. So that's, you take the entire production of the economy and divide it up on a per person basis. And as you can see, the black line here, it's been rising nicely throughout this whole period. The bottom 50% of the population and the middle 40%, so that's 90% of the population, fell considerably behind over this whole period. That's evident here. If you were at the 90th percentile and really up to the 95th, you kind of kept up with your share of GDP, but it's really the top 1% and then the top hundredths of a percent that won the sweepstakes. And just to remind you, the top 1% is 3.3 million people. The top 100th of a percent is 33,000 people out of a total population of 330 million. So that's what things look like today. Here's a brilliant question, and I readily state that I didn't come up with this question. It was an economist at the Rand Corporation who asked, what would income distributions look like today if the sharing trend of the 1948-1979 period had continued? And this is a reference, so this is Carter Price and Catherine Edwards, this rather droll title, Trends in Income. But at any rate, you can see the reference in the description below the video. So here's what they found, and we're going to spend a few minutes looking at this. So what they did was they studied carefully what each of these segments of population, so this is 25% of the 25th percentile of the population, the median, so 50%, 75, and so on. They looked at how that income grew from 1975 to 2018. And we'll just stick with the 25th percentile for the moment. So it grew from 28,000 to 33,000 in 2018. And then they said, well, if that cohort had continued to share an increase in income as it had in the period from 1948 to 1979, what would it be in 2018? It would have been $61,000. So that's like 90% more than what they actually received. And in fact, this 15% is the increase between 28,000 in 1975 and 33,000 in 2018. So that's a span of 43 years. So even at the 75th percentile, their income grew from 58,000 to 81,000 in 2018. But if it had followed the trends of the 48 to 79, it would have been 126,000. So that cohort, the 75th percentile, actually only grew 33% between 58,000 and 81,000. The winners really are the people at the very, very, very top of the pile. So you take a look at the 99th percentile, and their income grew from 257,000 in 1975 to 761,000 in 2018. But if their income had followed the trends of 48 to 79, it would have only been $560,000. So they really want their income. They got a much larger share, 166%. And then, of course, the mean of the top 1% was 321% growth. They ended at 1,384,000 in 2018. If they'd followed the trends of 1948 to 79, they should have only earned 630,000. So they much more than doubled their share. And here's another way of looking at this. This is a graph. This line here is logarithmic. It's not linear, so don't be confused by the spacing of these indices here. So let's just take a look at the top 1% mean. So in 1975, they were, let's go back for a second. In 1975, they were at $289,000 was their income. In 2018, they had reached $1,384,000. If they had followed the projections, the trend lines from 1948 to 1979, they should have only been at around, what is that, 680. Let's go back. They should have been at $630,000. So the vast majority of the money ended up in the very top of the pile. So here's the question then, what's the scale of this ripoff? You know, it's one thing to look at individual numbers, but how much when you add it up over those, on that time period from 1979 to 2019, which is 30 years, let's add up all of the income that would have been in the hands of the bottom 90% of the population if the 1948 to 1979 trend had continued. And it's really a very big number. It's the $47 trillion, which is 47 followed by 12 zeros. So this is really hard to get your head around. I mean, what do we do with all those zeros? So I came up with a couple of rubrics to help me get my head around, well, what is this number? And so one of the things I thought of is how many dollar bills do you need to pile up to equal the 1,550-foot height of this Billionaires Row Tower in New York City? Well, it's 4,300,000 dollar bills. That equals that tower, Central Park Tower. So how many of these Central Park Towers would you have to pile up? Because 4,300,000 is a very long way from 47 trillion. So how many towers do you have to pile up? I mean, just to kind of cogitate for a moment. Well, to equal 47 trillion, you'd have to add on 10,929 Central Park towers. So it is truly a gigantic number. Then I thought of, well, what if we looked at the economic output of the world? 47 trillion is the combined output of every country in the world in 2022, except the top 5: India, Germany, Japan, China, and the US. Or another way of looking at it is it's the combined output of China, Japan, Germany, India, UK, France, Italy, Canada, Brazil, Russia, and South Korea. So the top 10 economies in the world, not including the US. And just for comparison's sakes, the output of the 2 largest economies in the world, the US and China, was a mere 41 trillion in 2021. So how did this happen? I mean, let's be clear. It's not a natural functioning of the economy. It's not free markets in action. Everyone talks about the self-equilibrating market, the ideal decision maker market about what to invest in, the market that automatically adjusts supply and demand and it set prices accordingly. That's not what this is about. And it's also not the results of the genius and hard work of the rich and corporations in the economy, but it is the results of the genius and hard work of the rich and corporations in a political movement. So working with academics and politicians, the rich and corporations developed a political movement in the 60s and 70s. This movement changed the rules and regulations that govern the capitalist system. It has several names: free market capitalism and neoliberalism. You can use whichever you want. I'm not going to enter into a discussion about those names. And you're not going to be surprised by the principles of free market capitalism because they are so deeply embedded in our public thinking, in our academic thinking, in our politicians' minds, in the mass media. They've been extremely successful in spreading these ideas around. So free markets, we've already talked about that. Success or failure is in each person's hands. This is really an ode to individual responsibility. Minimal government, so small government is the only government. Privatization of government affairs. Deregulation, getting the government out of the way. Free trade, so we have all sorts of free trade agreements around goods and services. This allows for things to move around in the world without tariffs and other taxes when it crosses boundaries. And importantly, this includes the movement of money. Globalization was also included. Financialization is an interesting kind of topic. The finance sector, which includes banking, insurance, and stock markets and so on, has grown in the U.S. and also in the U.K. As a percentage of the overall economy, but it's almost doubled in the last 25 years. Importantly, the share of profits by the finance sector has more than tripled over the same period of time. And then there's a second kind of aspect of financialization, which is the financialization of the management of corporations. So under that regime, famously, Milton Friedman said that the only job of a company is to increase shareholder value. And this has led to the whole many schemes of extracting financial value, but while not paying attention necessarily to customers, products, and services, and the normal things that traditional management thought about. And then finally, economic growth and innovation originate in the market. Government contributes nothing or is a hindrance. That's the claim. Now, since most of you are watching this either on a smartphone like an iPhone or on a laptop, you should take note that all of the underlying fundamental technologies of these devices were developed with government money. So that's just silly business. These must be taken on faith because there's little or no empirical evidence to support most of these assertions. And they're exactly that. They're assertions of values. So how did the most successful political movement of the 20th century work? And I pause here because my stepson, Jonathan Leonard, is a professor of political economics in Leiden in the Netherlands, pointed out to me that this top-down political movement, and that's what it is, it's a top-down political movement. It's not a mass movement of unions or people in a political party. It's the elites imposing their will on things. So they undertook this this movement, and they established all sorts of think tanks and involved universities and departments of economics and business schools and so on to train people in free market economics. They monitor books and media for challenges to free market capitalist thinking, and they have carried out information campaigns in print, radio, TV, and now on social media to propagate these ideas. Most importantly, in many ways, they lobby in Washington and in the states, and they co-opt regulatory bodies, which means it's sometimes referred to as regulatory capture by industry. So industries get people placed on these regulatory bodies to write the regulations and then to oversee the regulations. And then finally, they control national politicians, and we'll talk more about that. You should check out this Lewis Powell memo, Confidential Memorandum Attack on American Free Enterprise System, which he wrote for the American Chamber of Commerce in 1971. It's frequently cited as kind of the basic game plan for free market capitalism thinking. So lobbying is really big business. $4.1 billion was spent in Washington on lobbying in 2022. There are more than 12,000 lobbyists, and that converts into $7.7 million for each congressperson and senator, and 22 lobbyists knocking on their doors, taking them to lunch, playing golf, and whatever else fat cats do. And this is really an effective strategy. And believe it or not, there's actually an empirical study by two professors at Princeton where they tracked all of this. And their summary is the economic elites and organized groups representing business interests have substantial impacts on U.S. government policy, while average citizens and mass-based interest groups have little or no influence. So what was the effects of these policies? We've already talked about the increase in income inequality. I'll just mention that the situation with wealth inequality is even worse. There's been a staggering decline in the rate of unionizations. So you go from a unionization rate of about 27% in the 70s to less than 10% today, and most of those are government employees. This has meant that the power of workers to extract their gains in wages is very, very small. There's been an increase in economic concentration. I'm going to talk a little bit further about that. Healthcare, we pride ourselves on having a market-based healthcare system. Well, it's twice as expensive as other developed countries, and it delivers lousy results. There are free trade agreements all over the place. NAFTA, Pacific Trade Organization, and more. And these are all part of the effort to break down barriers and tariffs and taxes and get products and services and money to flow across state boundaries without any interference. There's been a huge flight of jobs from the U.S. to low-wage countries. As part of the small government theme, There's been a decline in funding for infrastructure and public higher education. We've already mentioned that the political system is controlled by the rich and corporations. And one of the things that we can take note of is that we now have essentially a two-tier system of employment. About 20% of the workforce works for the FTE sector. So FTE stands for finance, technology, and electronics. Everybody else works for low-wage jobs. And finally, there's the socialization of economic malfeasance. These are the bailouts, which we saw outrageously large numbers of dollars given to financial institutions of one sort and another, particularly notoriously in the 2008-9 global recession. So here's a few details. Monopolization. Monopoly inspires the idea that there's one company that's controlling a market. Well, that's not really what is going on here. We're talking about a concentration of ownership. So the normal definition goes somewhat like this. A market is considered concentrated if 2 or 3 companies control more than 50%. These companies control prices, exercise control over their suppliers, and prevent competitors from entering the market. So here's a kind of a listing. It's not exactly comprehensive, but it indicates to you the scope and scale of markets in the United States that are concentrated. Some of these we have, regular interface with, like grocery stores, drug stores, airlines, rental cars, and here's just a couple of examples. So beer, 3 companies control 75% of the whole beer market. And this one is really startling to me. Home improvement. So this is where you buy your lumber and nails and stuff like that. Home Depot and Lowe's control 81% of this market. So what about the flight of jobs from the U.S. to low-wage countries? Well, here's just one chart about manufacturing employment, and you can see that somewhere around 2000, there began a steep slide of manufacturing jobs out of the U.S. economy, and China being the recipient of most of these. But about 5 million jobs disappeared, and a very significant change in the workforce. So what can we say in sum about all of this? The rich and corporations understand that the economy is a human construction, not a feature of nature, and that the rules and regulations are established by the government. So they understand that. Your Econ 101 course somehow never comes to say this. So they've captured government and dominated the public discussion for decades. Much of the academic and expert world is either directly on their payroll or deeply in their thrall. So we need to develop a mass politics that reflects the interests of the bottom 90% of the population. And in my view, there's much in common across the various geographic and demographic divisions of our country. We need to articulate things that are common across them. And certainly the impact of free market capitalism is one of those. So what can we do at a practical level? First, we've got to make the political system more democratic. We have to somehow or another break up the control by the rich and corporations of our politics. So one thing to do is to end anonymous money in politics. And a second would be to outlaw politicians taking money from corporations. Corporations are not people. They are not human beings. They are the creation of laws. So we shouldn't treat them as anything other than that. And we should publicly fund national and state level elections. The access by the vast majority of the people to representation and being a representative, both at the federal and state levels, is bounded by the need to raise enormous amounts of money. So by publicly funding it, we would go a long way towards breaking that up. And then we can change some things about how corporations are governed. One of them is to end anonymous shell corporations. The real owners and managers of every business should be visible immediately. They shouldn't be hidden behind waves of lawyerly baloney and these artificial constructs. We can put employees and taxpayers on the board of directors of public and private companies with sales of more than $100 million. This is something that a number of European countries have done to good effect. And we should change corporate management incentive packages to reward real value creation, so creating new and interesting products and services, not financial engineering. So this is promoting value creation over value extraction. And then third, we can change government laws, regulations, and oversights. And there's a lot of things to be done in this category. One of my favorite ideas is similar to California's 3 strikes and you're in jail forever law. I would like to have a law that says 3 strikes and you're dissolved. So corporations that repeatedly violate laws and regulations, we just simply break them up and sell them off. And we should also penalize senior managers who are involved in this for repeated corporate criminality. Definitely, we have to break up the monopolies. This is incredibly important because the monopolies exercise all sorts of controls over both prices and the way in which their suppliers act and access to the markets for new competitors. And finally, get tough on corporations illegally harassing unions. And we can definitely reinstate the separation between commercial bank and investment banking. This is one of the crimes of the Clinton era, was the deregulation, the end of the Glass-Steagall Act, which kept commercial banks and investment banking separate. So investment banks were not allowed to play with other people's money, namely the public's deposits. And here's a few more. We regulate financial speculation, end high-frequency trading, tax subsidies. It's incredible to me that the petroleum industry, the agribusiness, and many other businesses receive subsidies from the government. And we should establish a minimum corporate tax. And end the use of secret offshore banks. I mean, it's just amazing that we allow corporations that are legally established in the United States to hide money offshore to avoid taxes and avoid other burdens. And make sure the rich pay more taxes than people at the 80th decile of the population. Famously, Warren Buffett, one of the richest people in the world, has noted that his effective tax rate is lower than his secretary. And end tax support and favoritism for private equity and other financial extraction schemes. And finally, enforce U.S. labor and environmental standards on products and services imported into the U.S. So, thanks for watching this episode of American Delusions. Subscribe. Visit us at AmericanDelusions.com. Thanks.